The machine doesn't announce itself when it starts. There's no switch thrown in a darkened room, no single decision that sends the gears whirring. Instead, it hums quietly beneath everyday life, beneath mortgages signed at kitchen tables, government budgets debated under fluorescent lights, and the glow of trading screens in glass towers. It's a machine built not of steel and wire, but of promises, of obligations deferred into the future, of numbers that compound while we sleep. Its name is debt. By the time most people become aware of it, the machine is already everywhere. In the early hours of a weekday morning in New York City, as the sun reflects off the East River, trillions of dollars in debt silently change hands. Treasury bonds are priced and repriced. Interest rates flicker by fractions of a percent. Algorithms trade futures contracts tied to government borrowing that won't mature for decades. Somewhere in Washington, the Treasury prepares another auction. In Tokyo, a pension fund buys it. In Frankfurt, a central banker watches the yield curve bend. None of these act as villains. None are heroes. Each is just responding rationally to incentives created long before they arrived. And yet, together, they feed a system so vast and entrenched that entire economies now depend on its constant expansion. This is the debt machine, and this is the story of how it came to dominate the modern world. To understand it, we have to go back. Before derivatives, before central bank balance sheets measured in trillions, before the word leverage entered our vocabulary, we have to return to a time when debt was feared, not embraced, when it was treated as a moral failing as much as a financial tool. For most of human history, debt was personal, local, and dangerous. In ancient Mesopotamia, clay tablets recorded loans of grain and silver. If you missed a payment, you could lose your land, or even your freedom. In medieval Europe, debtors' prisons were common, and charging high interest was seen as unnatural, even sinful. Even in early modern capitalism, debt carried a stigma. Merchants borrowed, sure, but governments were expected to balance their books, and households were warned to live within their means. That worldview wouldn't survive the Industrial Revolution. The 19th century rewired our economic imagination. Railroads, factories, and steamships demanded capital on a scale the old world had never seen. Growth was no longer slow and steady. It was explosive. To build faster and bigger, societies turned to credit. Governments borrowed to wage wars and build infrastructure. Corporations issued bonds. Banks learned to multiply money. Debt was no longer just tolerated. It became essential. But even then there were limits. The gold standard constrained governments. Bank runs punished risky behavior. Crises were brutal, but they were contained. When credit expanded too far, a collapse would follow, wiping out the overextended and resetting the system. The modern debt machine one that no longer resets required something new. It required a fundamental change in how money itself worked. Picture this: summer 1944. World War II is still raging, but in a quiet New Hampshire resort town, a group of people are already building the future. 730 delegates from 44 countries gathered at Bretton Woods. Their goal: to prevent the economic chaos that led to the Great Depression and the war. They needed a system, something stable. Their solution was elegant. The US dollar would be the king, pegged to gold at a fixed price. Every other currency would then peg to the dollar. This created a predictable, stable world. And for a while, it was a golden age. The post-war decades saw incredible growth, rising wages, and surging productivity. The economic machine was powerful, but it had guardrails. But all good things. By the late 1960s, the U.S. was spending heavily on the Vietnam War and new social programs. It printed more dollars than it had gold to back them up. The system was straining. The breaking point came on a Sunday evening in August 1971. President Nixon went on TV and announced the U.S. would temporarily stop converting dollars to gold. That temporary suspension became permanent. The anchor was cut. For the first time in modern history, money wasn't tied to anything physical. Currencies floated freely against each other. Governments could now create debt with much less discipline. This unleashed the debt machine. The 1970s were chaotic inflation, oil shocks, economic turmoil. It seemed like a disaster, But the response to this chaos set the stage for the world we live in today. In 1979, with inflation soaring, Federal Reserve Chairman Paul Volcker did something drastic. He jacked up interest rates to historic highs. It caused a painful recession, but it crushed inflation. This taught policymakers a powerful lesson. They could steer the entire economy just by changing the cost of debt. Debt was no longer just a byproduct of the economy. It became the primary tool to manage it. The floodgates opened. The 80s and 90s saw a financial explosion. Mortgages were bundled and sold as securities. Complex derivatives were invented. Capital flowed freely across the globe, chasing higher returns. For governments, borrowing became easier than raising taxes. For corporations, debt juiced their profits. For households, credit cards and mortgages became a way of life. We were all encouraged to borrow against our future. And every time the system wobbled, it was rescued. The 1987 market crash, the savings and loan crisis, the Asian financial crisis. Each time, central banks and governments stepped in with more loans, more liquidity. The message was clear. No matter how risky things got, the system would be saved. The debt would be rolled over. By the early 2000s, this debt machine was humming. Interest rates were low, credit was cheap, and housing prices seemed to only go up. Risk hadn't disappeared. It had just been sliced, diced, and scattered so widely that no one could see where the danger truly was. And then, in 2008, the machine broke through the surface. Lehman Brothers collapsed. Credit froze. The global financial system teetered on the very edge of total failure. For just a brief moment, the world confronted the possibility that this debt machine might actually be dismantled, or at least downsized. Instead, it was rebuilt, bigger than ever. Central banks slashed interest rates to zero. They created trillions of dollars, euros, and yen out of thin air to buy up government bonds and private assets. Their balance sheets ballooned to sizes never seen before. Governments started running deficits that were previously considered unthinkable. Private debt was socialized. The losses were absorbed upward into institutions that were deemed too important to fail. The crisis didn't end the era of debt. It cemented Italiano. From that point forward, the machine became self-reinforcing. Economic growth depended on more borrowing. Asset prices depended on low rates. Governance depended on cheap financing. Any attempt to slow the system down risked a total collapse. Any attempt to stop it seemed impossible. And yet, beneath the smooth, confident language of policy statements and market forecasts, cracks were forming. Productivity growth slowed to a crawl. Inequality widened dramatically. Younger generations found themselves completely priced out of housing, burdened with massive student loans, and told to just be patient while debt-fueled asset booms enriched those who already owned capital. Entire economies became addicted to stimulus, unable to function without constant injections of credit. The debt machine was no longer just an economic system. It had become a political one, a social one, a psychological one. In the next part of this story, we're going to step inside the institutions that power this machine. The central banks, the treasuries, and the financial markets, where decisions made by a handful of people ripple outward to shape the lives of billions. We'll see how seemingly rational choices, made under immense pressure and uncertainty, locked the entire world into a system that now struggles to even imagine an alternative. And we're going to ask the question that hangs over the modern economy like a gathering storm. What happens when a machine built on endless borrowing finally reaches its limits? Imagine a room. It's quiet, almost antiseptic. A long, polished table stretches out beneath recessed lights. Screens glow softly along the walls, displaying charts that either curve sharply upward or plunge without any warning. Around this table sit economists, lawyers, and policymakers, men and women who are trained to speak in careful, measured language, to measure risk in tiny fractions called basis points, to weigh the cost of action against the danger of hesitation. This is the control room. This is where the debt machine is managed. Central banks are often described as these purely technocratic institutions, completely insulated from the messy world of politics, guided only by complex models and their official mandates. But in reality, they are human organizations. They navigate uncertainty, fear, and immense pressure. Every single decision they make reshapes incentives across the entire economy, quietly determining who can borrow, who is encouraged to save, who prospers, and who falls behind. To understand how debt became the dominant organizing force of our modern economies, we need to understand how central banking itself evolved and how its role expanded far, far beyond its original purpose. The earliest central banks weren't designed to manage economies at all. They were created to finance states, specifically for war. The Bank of England, founded way back in 1694, was essentially a war-funding mechanism. In exchange for lending a huge sum of money to the Crown, it received the exclusive right to issue bonds. This arrangement tied public debt directly to the money-supplier relationship that would echo through centuries of financial history. For a very long time, central banks played a narrow role. They were there to maintain currency stability, act as a lender of last resort when things went wrong, and ensure that governments could borrow money in times of crisis. They were mostly reactive institutions, stepping in only when markets seized up. But that all changed in the aftermath of the Great Depression. The sheer scale of the economic collapse forced a radical rethinking of the role of government and finance. Policymakers, desperate to avoid a repeat of the 1930s, looked for new tools to manage the economy. They found them in the theories of John Maynard Keynes, who argued that governments could and should use spending and borrowing to counteract economic downturns. This shift gave central banks a new, much more active mission to manage the business cycle, to fine-tune the economy by adjusting interest rates and controlling the supply of credit. The idea was to smooth out the booms and busts, to keep unemployment low and growth stable. For a few decades after World War II, in what's often called the Great Moderation, it seemed to work. Economies grew, inflation was mostly under control, and financial crises were rare. Central bankers were seen as masters of the universe, the calm technicians, steering the ship of state through calm waters. But this new power came with a hidden cost. By making it their job to prevent recessions, central banks created a sort of safety net for the financial system. They taught investors and banks that whenever trouble started, the central bank would step in to cut rates and provide liquidity. This is what's known as moral hazard. If you know you'll be bailed out, you're more likely to take bigger risks. Over time, this created a dangerous feedback loop. Each crisis was met with a bigger and bigger monetary response. Each bailout sowed the seeds for the next, even larger crisis. The system became more and more leveraged, more and more fragile. The Asian financial crisis in 1997, the Russian default in 1998, the dot-com bust in 2000. Each time, the response was the same: cut interest rates, flood the system with money, and push the problem down the road. The goal was no longer just to manage the economy. It was to protect asset prices. A falling stock market or a drop in housing prices was seen as a direct threat to economic stability. Central banks became trapped. They had created a system that couldn't handle even minor corrections without risking a full-blown meltdown. They were no longer just referees. They had become active players, constantly intervening to keep the game going. This brings us back to 2008. The collapse of the housing bubble wasn't just another crisis. It was the culmination of decades of this policy. It was the moment the system of ever-increasing debt and risk finally broke. But the response was not to fix the underlying problem. The response was to double down. The decision to launch massive quantitative easing, or QE, was a pivotal moment. It was an unprecedented experiment. Central banks began buying trillions of dollars of government bonds and other assets directly. The stated goal was to lower long-term interest rates and encourage lending. But it had another, more profound effect. It completely blurred the line between monetary policy and government finance. By buying up huge quantities of government debt, central banks made it incredibly cheap for governments to borrow. They effectively enabled the massive deficits that were needed to bail out the banks and stimulate the economy. It was a modern version of what the Bank of England did in 1694, financing the state by creating money. The difference was the scale, which was now global and astronomical. This policy saved the system from immediate collapse, but it locked us into a new reality, a world of permanently low or even negative interest rates, a world where asset prices, stocks, bonds, real estate, became completely detached from the underlying health of the real economy, driven instead by the constant flow of central bank liquidity. This environment has fundamentally changed how our society works. It punishes savers with near-zero returns on their money. It forces everyone, from pension funds to individual retirees, to take on more and more risk just to get a decent return. It fuels speculative manias in everything from tech stocks to crypto, and most importantly, it makes it almost impossible to ever return to normal. Any attempt by a central bank to raise interest rates or shrink its balance sheet, what is known as quantitative tightening, sends shockwaves through financial markets. We saw this in 2013 with the taper tantrum, and again in late 2018. The market has become so addicted to cheap money that even the hint of taking it away can trigger a panic. The people running these institutions are not villains. They are intelligent, well-intentioned individuals trying to navigate an impossibly complex situation with limited tools. They are responding to the pressures of the moment, trying to prevent disaster. But the cumulative effect of their decisions has been to create a system that is fundamentally unstable, profoundly unequal, and which seems to have no clear exit ramp. They are trapped by their own success. They prevented a second Great Depression. But in doing so, they created a zombie economy, one that is kept alive by constant life support from the central bank, but is incapable of generating healthy, organic growth on its own. The debt machine is now fully automated. Its logic is inescapable. Growth requires debt. Debt requires low rates. Low rates require central bank intervention. And central bank intervention fuels more debt. It's a circular logic from which there appears to be no escape. Have you ever wondered why our world seems to run on debt? It wasn't always this way. Let's rewind to the 1930s. The Great Depression wasn't just an economic collapse. It was a brutal lesson. When banks failed and credit vanished, governments learned a hard truth. Leaving financial systems completely to the market could destroy society. This is when central banks started to change. They weren't just guardians of money anymore. They became stabilizers of the economy. After World War II, this idea went mainstream. Thanks to Keynesian economics, government deficits were no longer seen as reckless. They were tools to fight downturns and boost employment. Debt became something to manage, not something to fear. But there was always a line you couldn't cross. Inflation. Print too much money, borrow too much, and prices would spiral out of control. The memory of hyperinflation, like in Weimar Germany, was a powerful warning. Stability demanded restraint. However, that discipline started to fade. By the 1980s, the financial world was getting incredibly complex. Banks weren't just holding loans. They were selling them, moving risk into the shadows of the financial system. Governments jumped on the deregulation bandwagon, believing markets knew best. Central banks narrowed their focus to just one thing: inflation. As long as prices were stable, everything was assumed to be fine. This was a dangerous oversimplification. While inflation stayed low, a mountain of debt was building up unnoticed. Why didn't prices skyrocket? A perfect storm of globalization, technology, and cheap imports from places like China kept consumer prices in check. So, while your grocery bill wasn't climbing, debt was expanding everywhere. Households borrowed against their rising home values. Corporations issued bonds not to build new factories, but to buy back their own stock. Governments racked up liabilities, all while promising that low interest rates were here to stay. This debt machine grew, not because of some grand plan, but because in the short term, everyone was benefiting. Then 2008 happened, and central banks crossed a line they could never uncross. When the global financial system froze, just cutting interest rates wasn't enough. They were already near zero. So, they unleashed a new weapon: quantitative easing, or QE. They created money out of thin air and used it to buy government bonds and other assets. This flooded the markets with cash. The official goal was temporary stabilization. The reality was a permanent transformation. QE blurred the line between the government's budget and the central bank's actions. Suddenly, central banks were the biggest buyers of their own government's debt. A new rule was established in the minds of investors: if markets fall too far, the central banks will step in. This wasn't a temporary fix, it was a fundamental shift. Think about the psychology. For decades, The lesson was that markets have cycles, and bad decisions get punished. After 2008, a new belief took over. Central banks won't let the market crash. This unspoken guarantee changed everything. If borrowing is cheap and bailouts are likely, why not borrow more? Corporations loaded up on debt, confident they could just roll it over forever. Governments kicked the can down the road on tough financial decisions, and the biggest banks grew even bigger, knowing they were now too big to fail. Debt was no longer a temporary bridge to get through a tough time. It had become the road itself, the very foundation of our modern economy. Have you ever wondered why our economy feels like it's built on a house of cards? It's not just you. Let's talk about the real story behind the money. And it all starts with the central banks. But here's the twist. They weren't acting alone. Their decisions, the ones that control interest rates and the flow of money, are deeply tangled up with politics. Think about it. Politicians need to get re-elected, and voters want growth, jobs, and for their investments to go up, raising taxes. That's political suicide. Cutting popular programs, just as bad. So, what's the easy way out? Borrowing? It's like a magic trick. Deliver all the goodies now and push the bill into the future. Over time, government spending became completely hooked on this cheap money from central banks. Low interest rates meant borrowing was practically painless. But if those rates went up, the national debt would explode. This created a quiet but powerful dependence. Officially, institutions like the Federal Reserve are independent, but in reality, could they really hike rates if it meant crashing the whole system? The pressure to keep the easy money flowing was immense. Every time they tried to get things back to normal, to raise rates just a little, the markets would panic. Debt payments would spike. The economy would start to slow down, and immediately, the calls would come to reverse course and open the taps again. The machine just refused to be slowed down. Nowhere was this more obvious than in the housing market. All that cheap money transformed a basic need, a home, into a high-stakes financial asset. Mortgages got longer. People borrowed more and more compared to their income, and house prices soared, completely detached from what local salaries could actually afford. It was a global game of monopoly. Fueled by cheap credit, if you already owned a home, you felt richer and richer. But if you were trying to buy your first place, or even just renting, you were being locked out. The system was actively rewarding the asset owners and punishing everyone else. This wasn't some grand conspiracy. It was just the natural result of all these little policy choices made under pressure, year after year. This same pattern played out everywhere. In finance, borrowing more meant making more. In education, student loans ballooned as public funding dried up. In healthcare, a jungle of complex billing systems grew, all based on paying later. Debt was the universal patch, filling all the holes left by political compromises and massive changes in our society. By the end of the 2010s, global debt had hit levels never before seen in peacetime. The numbers were astronomical, trillions upon trillions, but we'd become numb to them. They were just abstract figures on a screen. Then, 2020 happened. The pandemic shut down the entire world, almost overnight. Businesses closed, people stayed home, and the global economy slammed on the brakes. The response was bigger and faster than anything we'd ever seen. Central banks didn't just open the floodgates. They blew the dam wide open. Interest rates were slashed to zero. They started buying up assets on a scale that made the 2008 crisis look like a warm-up act. Governments spent trillions on relief programs, and the central banks just printed the money to cover it. The once unthinkable became the new normal. The debt machine didn't just survive this massive shock. It got bigger, stronger, and more essential than ever. But this came with a heavy price, and it wasn't shared equally. While stock markets and house prices went to the moon, millions of people struggled to get by. Supply chains broke, and something we hadn't seen in decades came roaring back. Inflation. Suddenly, the delicate balance was gone. Policymakers are now scrambling, faced with a terrifying truth. The very tools they used to keep the machine running are now the things that could cause it to collapse. If they raise interest rates to fight inflation, they risk a global debt crisis. If they keep rates low, they risk their currencies becoming worthless and causing massive social unrest. There are no easy answers left. The machine has grown too big to fail, but it's also become too fragile to keep running on full blast. Take a look at this street, quiet, orderly, with identical houses lined up one after another. Lawns are perfect. Driveways are full. On the surface, it's the picture of middle-class security. But behind these doors, a silent struggle is playing out. For millions, the household budget is a tightrope walk, balanced on interest rates set by people they will never meet. This is where the global debt machine gets personal. Debt isn't some abstract number on a chart. It's the car payment you have to make every month. It's your credit score, a number that can open or close doors to your future. It's that late-night calculation, trying to figure out how to pay for today without sacrificing tomorrow. There was a time when borrowing was a path to building wealth. Think about it. Our parents or grandparents took out a mortgage, paid it down over 30 years, and owned a home. A car loan was manageable because wages were actually going up. Savings grew right alongside the economy. But that connection has snapped. Over the past few decades, the cost of living has skyrocketed, while wages for most people have flatlined. So, what filled the gap? Debt. Things that used to be the bedrock of a secure life. A house, an education, healthcare, are now mostly financed instead of paid for. The promise was always that the economy would grow, and your future income would easily cover today's borrowing. But for so many, that promise never came true. This shift didn't happen overnight. It started back in the late 20th century. Globalization and new technology changed everything. Good-paying manufacturing jobs vanished. The service industry grew, but often with lower pay and zero stability. The economy kept growing, but most of the gains went to the people at the very top, not to the workers doing the labor. Our dreams didn't get smaller, but our paychecks did. To keep the dream of stability alive, policymakers pushed homeownership for everyone. Banks loosened their lending standards and created all sorts of complex financial products. Suddenly, a house wasn't just a place to live anymore. It was an investment, your retirement plan, a personal ATM. And as long as home prices kept climbing, everything seemed fine. But when the music stopped in 2008, the system imploded. The housing collapse wasn't just a financial crisis. It tore a hole in the fabric of our society. Millions lost their homes. Entire neighborhoods were hollowed out. People lost faith in the very institutions meant to protect them. And the recovery, it just made the divide even wider. If you already owned assets like stocks or property, you did great. If you were a renter or buried in debt, you fell even further behind. A whole generation grew up in the shadow of that crash. For us, the rules of the game were completely different. Student loans replaced grants as the main way to pay for college. You now need a degree for jobs that never required one before. As a result, young adults are putting off buying a home, getting married, and having kids. Not because they want to, but because they can't afford to. Debt is shaping our biggest life decisions before we even start our careers. And this wasn't an accident. Higher education turned into a massive business, fueled by government-backed loans. The risk was shifted away from the universities and placed squarely on the shoulders of students. So, colleges expanded, tuition soared, and taking on massive debt became the new normal. The price of admission to the middle class. For some, that bet paid off. But for millions of others, it became a financial trap they may never escape. The balance sheets inside these quiet suburban homes tell the real story of our economy. We see the exact same pattern in the housing markets of big global cities. Think about London, New York, or Sydney. These places became magnets for global money. Real estate wasn't just about having a home anymore. It became a worldwide asset class for investors. As a result, housing prices completely disconnected from what local people were actually earning. This created a strange situation. Cities were booming economically, but the people living and working there felt more insecure than ever. They were working longer hours, just to have less and less access to the very places they called home. To buy a house, people had to take on mortgages that stretched for decades, making them incredibly vulnerable. A tiny change in interest rates, just a quarter of a point, could be the difference between staying afloat and financial disaster. And it's not just individuals or families. Entire countries got caught in the same trap. They'd borrow heavily during good times, funding big projects and social programs. It all seemed fine, a sign of progress. But when a global crisis hit, like a pandemic or a financial meltdown, that debt became an anchor, dragging the whole economy down. The promises of growth faded, but the obligation to pay back the money with interest remained. The very systems designed for stability ended up creating widespread vulnerability. It makes you wonder, when did we all agree to this? Remember the Southern European sovereign debt crisis? It was a brutal lesson. Countries like Greece joined the euro and borrowed cheaply. But when the market got spooked, things went south fast. Austerity measures meant to fix the problem just made recessions deeper and society more divided. Debt, which was supposed to help countries grow, became a tool of punishment. But here's the crazy part. The system kept going. Why? Because the alternatives seemed even worse. Defaulting on debt? Imagine the chaos. Letting inflation run wild. That destroys trust. Political chaos. Nobody wanted that. So, debts were just kicked down the road, restructured, and extended. We boothed time, but the problem only got more entrenched. Financial markets are smart, though they adapted. Investors started looking not just at a country's ability to pay, but at whether central banks would step in to save the day. The game changed. It wasn't about can they pay, but will they be forced to pay? This shift changed everything about how money moves around the world. Safe places to put your money became rare. Interest rates dropped to almost nothing. This was a nightmare for pension funds and insurance companies. To meet their promises, they had to dive into riskier investments. The debt machine was pulling everyone in. And it wasn't just governments. Big corporations, swimming in cheap cash, had a choice. Invest in new, innovative projects that might not pay off, or use the money for stock buybacks and mergers to pump up their share price and executive bonuses. You can guess which one many chose. Debt became a way to juice up stock market gains, while real, long-term economic growth took a back seat. The result, we saw innovation get stuck in just a few industries. A handful of huge companies got even more powerful, and smaller businesses were squeezed out. Our economy became less dynamic, even as the stock market hit record highs. Then, in the early 2020s, inflation came roaring back. Suddenly, the whole system looked incredibly fragile. If central banks raised interest rates to fight inflation, it would crush borrowers from families with mortgages to entire governments. But if they kept rates low, everyone's savings would be worth less, and people would lose faith in the system. The easy choices were gone. Central banks started raising rates, but they had to be incredibly careful. Every little move could trigger a crisis. Markets freaked out at the slightest hint of tightening. Governments started sweating over their massive interest payments, and regular people felt the pinch in their daily lives. The debt machine, which once seemed like a solution, was now boxing us in. Dismantling it felt impossible. Every system has its limits, and the debt machine is no different. Its magic trick is pulling tomorrow's prosperity into today. It helps us smooth over crises, speed up growth, and delay pain. But the more we borrow from the future, the more the future starts to fight back. By the early 2020s, this wasn't just some abstract theory. You could see it in our politics, in the wild swings of the market, and in the quiet stress of families trying to make their budgets work. Inflation was no longer a ghost from the past. It was a real force shaking up society. Interest rates, once forgotten, became powerful weapons again. And the big question that policymakers had dodged for decades finally demanded an answer. How do you fix a system built on debt without blowing the whole thing up? There are really only a few ways out, and none of them are easy. The most common path is to try and inflate the debt away. A little bit of inflation can shrink the real value of what's owed, shifting wealth from lenders to borrowers. This is what many countries did after World War II. But it's a dangerous game. It relies on trust. If people start expecting high inflation, it can spiral out of control. Savers get angry, currencies get weaker, and the social fabric starts to tear. What starts as a quiet fix can end in total chaos. What other options are there? One is financial repression. In this model, governments and central banks team up to keep interest rates below inflation. They force domestic institutions to hold government debt. Through capital controls, regulatory pressure, and hidden guarantees, they funnel savings directly into state financing. The debt gets serviced, but it's slowly watered down, and the whole process is politically hidden. This strategy isn't new, and it has real costs. It crushes returns on savings and distorts investment decisions. It benefits insiders who know how to play the system, while punishing everyone else who doesn't have access to the right assets. Over time, this erodes public trust in markets as a source of opportunity for all. Then, there's restructuring. This means renegotiating debt, writing some of it down, or even defaulting. In theory, it's the cleanest solution. Losses are recognized and absorbed, but in reality, it's incredibly disruptive. Creditors take huge hits, banks become fragile, and a massive political backlash is almost guaranteed. In our interconnected global system, one country's restructuring can trigger a domino effect, causing a cascade of defaults. For countries with reserve currencies, like the US, default is simply unthinkable. For others, it might just be inevitable. The most radical path of all is complete transformation. This means rethinking the very idea of money, growth, and the assumption that prosperity must always be pulled from the future through debt. Instead, we could build it patiently through real productivity and fairer distribution. This path is the least clear and the hardest to follow because it doesn't just challenge policies. It challenges our core beliefs. Beliefs about what governments owe their citizens, what markets should reward, and what success even means in an economy that's hitting its physical, social, and psychological limits. The debt machine wasn't built by some secret group or a hidden conspiracy. It grew out of a series of rational decisions, all made under immense pressure. The goal was always to stabilize markets, avoid depressions, win elections, and protect people's livelihoods. Each decision made perfect sense at the time, but added together, they created a system that now limits the very choices we can make. Today, central bankers choose their words with extreme care, knowing that a single phrase can move trillions of dollars. Politicians debate budgets with the full knowledge that global markets are listening to every word. Investors analyze policy signals just as closely as they study company balance sheets. And households everywhere plan their entire lives around interest rates they have absolutely no control over. The machine just keeps humming along, powerful, adaptive, and becoming more fragile by the day. The real danger isn't that the machine will suddenly grind to a halt. The danger is that it will keep running, narrowing our options until a major shock becomes unavoidable, until inequality becomes so extreme it leads to instability, and until trust disappears faster than debt can be rolled over. History shows us that complex systems don't collapse because people are blind to the risks. They collapse because actually addressing those risks becomes politically and socially impossible. The decisions that created our modern economy were made to prevent disaster, and for a long time, they worked. But that success came with a steep price. The future of the debt machine won't be decided in a single dramatic crash or a high-stakes policy meeting. It will be shaped by countless small choices we all make. Will societies demand growth at any cost? Or will we choose sustainability, even if it requires sacrifice? Can our institutions adapt without living in denial? And will the burdens of this adjustment be shared fairly? Or will they fall on the few? Debt itself isn't evil. It's just a tool, one that amplifies our intentions. The question is no longer whether we live inside the debt machine. The real question is whether we can still choose where it takes us. Thanks for watching this episode of Inside the Debt Machine. Decisions that reshaped the modern economy on Economy Elite. If you liked this video, go ahead and watch another one right here on our channel.